From the floor of the CME Group, this is Danny Riley on this Friday, October 29th. Yep, that's what we're doing here. The S&Ps are moving all over the place. The interest rates are moving all over the place. And today we got a special guest coming on. We got Andrew Coffey from Option Monster coming on to tell us a little bit about his views of QE2 and all the other stuff. And then behind that, we've got George coming on to back up kind of what he's going to say. But real quick, as far as the S&Ps are concerned, it's exactly what we wrote in the Mr. Top Step Equity Report today. It's very quiet. The markets have been chopping around in a 3-4 handle range with nothing on either side of it. A couple of minutes ago, a headline came out that a UPS flight bound for London, a Yemen flight bound for Yemen, was held over in London, that they found a bomb in one of some type of cartridge, a printing cartridge. That in turn had the S&P sell off pretty quickly, but it really didn't go down very much. We're going to bring Andrew on right now.
Hello folks, my name's Andrew Coffey. I listen to Danny. I film this every day. I've created 3 great products for you, Mr. Top Step, R&B Brenna, and Jamie over at the VIX. But today I want to talk about QE2, because when Danny mentions it to me, or on this video, I always think of the cruise liner and cruising out to sea. But QE2 is quantitative easing, for I'm sure all of you know that actually watched this video. After Wednesday's Fed meeting coming up, the number that they're throwing around here on the floor is about $500 billion over 6 months. And that's the number. I just talked to George and he said the number's a little bit low, which I probably tend to agree with. Now, why do we need QE2? Because people aren't spending money. House prices are down. These are all obvious. Now, since April, only 50,000 private sector jobs have been created. That's not much, folks. So there's a lot of things going on here. Now, you have to also look at inflation. Now, the Fed uses a thing called PCE, which is personal consumption expenditures. That's sitting at around 1.5 right now. They took that CPI number off the table in 2000 at a Humphrey Hawkins meeting, where the Fed says we're going to go from CPI and we're going to use this PCE number. Now, we know it's coming up in election time. There's going to be gridlock. It's almost certain that that's going to happen. But that also means that there's not going to be any more federal stimulus. That means the Fed is the only game in town. That's the only way this is going to happen. Now, their thinking is, do you consume and invest today, or do you drive down interest rates? In 2008 and 2009, they spent $1.7 trillion on bonds. That's a lot of money, folks. Now, if you go back, because I know you all look at charts, August 27th, Bernanke gave a speech at Jackson Hole. It was called his More Liquidity. If you look at the charts, it's been up since then. And they're going to use POMO, which is the Permanent Open Market Operations, all right, or basically printing money. By driving down rates, people can do 2 things. You can either spend up for the bonds, which George will tell you about, or you can loan money out, like a bank, to somebody. But that's not happening either. This is the Fed's plan to stimulate the economy. But on the other hand of that, there's 5 hawks at the Fed, and you probably recognize their names. There's Thomas Hoenig from Kansas City, there's Richard Fisher from Dallas, Jeffrey Lacker from Richmond, and Charles Posner from Philadelphia. And you see these names coming up all the time. Basically, they're saying that they're forcing loans on people that don't even want them. And then the Fed says, well, we have an exit strategy. The exit strategy is either we can sell back the bonds that we bought in 2008 and 9 and make a profit on it. But what if? What if they had to raise interest rates? The 10-year is right about 2.6 right now. What if they had to lift up interest rates? They're going to take losses on those bonds. And Congress isn't going to like that too much. For lack of a better word, we'll call that plan that they're selling us every day an H. Plan H. Now, on the other hand, we could go to Plan O. Now, O is where they change the communication, where they said, well, we'll have maybe some future inflation down the road, but we promise to keep rates at 0. And then they'll throw that around. So that's Plan O, or 0, because we'll promise to give you 0 rates. Or we can go to Plan A. Now, Plan A works like this. They lose control of the balance sheet, and Congress buys as many bonds as they want. And they don't just target the 10-year. They throw the money all around. They could push the 10-year to maybe 2%. All right? That's Plan A. Now, Bernanke said this in a speech in 2002. He said it was the handbook for tackling inflation, and that'd be Plan A. Now, to the most extremely dangerous plan is Plan X. X is when you collect no payroll taxes, stimulate the economy by just putting it all in people's pockets. Could it happen? Maybe. But the Fed would have lost full control of their balance sheet. That's all I have to say about this.
Hi folks, George Cavaligos. Andrew's commentary about H.O.A.X. is very timely, especially for us over here in the financial markets where I work. The bonds and notes are going to be directly impacted by this whole QE2 pattern here. This time around, the Fed is talking about just buying treasuries. The first QE, they were open assets. They were buying mostly mortgages at that point, trying to drive down mortgage rates. This time, they're trying to drive down mortgage rates by just buying treasuries. I think they've sort of sucked up all the market for mortgages. There are very illiquid markets in mortgages at this point, so now they have to focus on treasuries since they're printing more and more of these treasuries. It's the only place they can buy enough to really move rates at this point. Now the question that we've been kicking around up until recently has been, initially it was going to be a heavy dose of QE, whether it was $1 trillion or $2 trillion over an open time span, we didn't know. But as we've gone along in time here, we've had sort of a panic, and it went down to almost a point where we were questioning whether we were going to have QE2 at all. And as that was happening, the market had sold off. And we saw that up until yesterday morning when we got wind of a survey that the Fed had sent around to all the primary dealers, asking the primary dealers what they thought the effect on the markets would be, what they thought should be the focus of the QE, and what they thought should have been the size of the QE. And if you look at the survey, it looks like most of the primary dealers are leaning towards a bigger amount of QE, on the order of $1 trillion over some 6-month to 1 year time span. The market obviously looked at that as somewhat bullish, and we started rallying the notes and bonds yesterday morning after the jobless claims number put in a low right on the bell. We've been bid ever since then. All day yesterday the market was bid. All day today, even after the GDP number, a little bit weaker than expected, the market shot up even more. On the 10-year, we got right up to a very important resistance level, 126.09, 126.10, that I've highlighted on the email that we send out and we put up on the chat every morning. We're keeping an eye on that level, and the market's just sitting there right now. It's not backing off at all. What I'm looking for is reversal. If it trades back below 126.02 for any short period of time, that would give us a reversal pattern, and I would try a small short at that point. Right now, it's staying bid. It looks like it's going to go higher. It's probably got a shot at 126.18, which is the bearish downtrend line off of the recent highs on the hourly charts. That's going to all be kind of difficult to trade, obviously, as we await this QE2 stuff. And now we have this terrorism threat with bombs being found on planes flying into this country. That's going to keep an underlying bid, a sort of flight to quality bid under the market. So it's going to be tough to be short, but if the market does start to fail, you'll know it if we trade below 02. Otherwise, we're looking for a higher high up to that 126.18 level, and we're looking forward to QE2 announcement Wednesday afternoon. The next couple days are going to be tough trading. Keep a short-term outlook. Try to take a quarter of a point out of the 10-year, and that's all we're going to get, I think, at this point. Have a great Halloween weekend. Enjoy it.